All right. S&P 500, 6,950. That is a fresh record close, tacking on another 0.5%. The Nasdaq, it's the undisputed session leader, jumping 1.1%.
But the Dow Jones.
That is where the pain is living today. The heavy laggard shedding 0.9%, down 425 points.
It is, what, 15 minutes past the bell on this Tuesday close, and frankly, if you only look at that headline S&P number, you are missing the violence that just happened under the surface.
Exactly. We have to unpack this immediately because looking at the scoreboard, we're staring at a massive, almost historic divergence.
We really are.
Yeah, the S&P sitting at a record high, popping champagne. Well, the blue chips look like they're in, I don't know, a near-crash profile. It feels like we watched two completely different movies today.
It really was a tale of two markets. On one side, you have this, chip trade reacceleration pushing the tech sector and the Nasdaq to the moon.
Everyone chasing the AI dragon again.
Right. But on the other side, you have a specific violent sector purge happening in healthcare.
Right, and that drag on the Dow is significant.
Yeah.
But before we get into the individual train wrecks, and oh boy, we have a massive one to talk about with UnitedHealth, what was the overall vibe? Because watching the tape, it didn't feel like a euphoric record high. It felt tense.
It didn't feel euphoric because it wasn't. If I had to define the session character, I'd call it a choppy mess. You have these conflicting drivers fighting for the wheel.
Okay, so what were they?
The bull case is obvious. Traders are aggressively front-running AI earnings. Everyone is placing their bets, expecting beats from Microsoft and Meta tomorrow.
That's the FOMO kicking in, fear of missing out. They see the chart moving up and they just have to be involved.
Precisely. It's buy the rumor in its purest form. But the bear case came out of nowhere this morning and just smacked us in the face.
Consumer confidence
collapsed to a 12-year low. That checked any broad enthusiasm. It is very hard to have a truly euphoric, broad-based rally when the consumer, the person actually buying the goods, is telling you they're terrified.
So you have traders buying the AI dream with one hand and selling the economic reality with the other. That is a very strange disconnect.
That is the perfect way to put it. It's cognitive dissonance played out in billion-dollar volume.
Let's get into the head fake versus the real moves. Because the Dow wasn't just drifting lower today, it was getting hammered. And the culprit seems to be UnitedHealth. What on earth happened there?
This was a catastrophe, and we, aren't using that word lightly on this show. UnitedHealth, ticker UNH, collapsed 20%.
20% for a boring insurance giant? That is unheard of. That's the kind of move you expect from a small-cap biotech that failed a drug trial, not a cornerstone of the Dow.
It followed a Medicare Advantage rate shock. The government basically tightened the screws on reimbursement rates, but looking at the price action, this wasn't just a repricing, this was a specific liquidation-only environment.
Okay, explain that for the listeners who aren't glued to the level 2 screens.
It means there were no buyers. It didn't just dip, it opened down 16% at $294.
Wow.
A lot of retail traders might look at that and say, oh, look, a discount, time to buy the dip.
Catch the falling knife.
Exactly. And today, that knife went right through their hand. It did what we call a gap and bleed. It never found a floor. It closed at $281.47.
Gap and bleed. That is the stuff of nightmares for a long-term holder. Just watching the equity drain away all day, tick by tick. But then, to prove your point about the tale of two markets, you just look at General Motors.
A completely different story, and this highlights the schizophrenia of today's session.
Right. GM started choppy, looked a little weak at the open, but then it reversed and closed up 9.5%.
Driven entirely by that multi-billion-dollar buyback news, it shows that in this market, capital is mercenary. It doesn't care about loyalty. It is fleeing the policy risk in healthcare, where the government can wipe out your margin with a pen stroke, and sprinting toward the shareholder yield in autos and the growth in tech.
It's ruthless efficiency. Money goes where it is treated best. Speaking of sprinting, we have to talk about the key reversal of the day. If you were watching the commodities desk, you probably got whiplash. Let's talk about silver.
This was fascinating. If you blinked, you missed the top. We saw a textbook blow-off top, or what the technical analysts love to call a God candle failure.
A God candle. I love that term. Even if the result wasn't divine for the bulls. So paint the picture for us.
So in the Asian session overnight, silver went vertical. It was parabolic. It hit an all-time high of $117.54. It looked like it was going to 200.
Wow.
But then the flush came. It crashed 13% down to $102.52.
That is a massive intraday swing.
Yeah.
To go from 117 to 102 in a single session, that blows out every leveraged account in the game.
It does.
It managed to recover a bit to 112 by the bell, but the damage was done.
The psychological damage is done. This is a classic institutional distribution pattern. They push it up to liquidity, where everyone is buying the breakout, fill their massive sell orders into that buying pressure, and then pull the rug.
So what does that mean for the trade going forward?
The implication here is critical. If that $110 level breaks, the hard asset trade might be over for this cycle. That chart is broken for now.
So we have a broken chart in silver, a broken stock in UnitedHealth, but a record high in the S&P. Let's look under the hood. I want to talk about the internals, specifically volume verification, because sometimes a record high on low volume is just a summer Friday drift. Was that today?
Definitely not. I checked the print, the final consolidated tape. This was real engagement. Volume on the Nasdaq and S&P was 15% above the 20-day moving average.
So people were showing up to work. This wasn't algorithms trading against themselves in a vacuum.
They were. And look at UnitedHealth again. It traded 48.4 million shares. That is nearly 5 times its daily average.
5 times. That is a lot of paper changing hands.
It tells us this wasn't retail traders panicking. Retail doesn't have that kind of firepower. This was active institutional repositioning. They were exiting defensive value dumping the insurers and piling into the tech complex.
They sold the Dow to buy the Nasdaq.
Pretty much. Which explains why the Nasdaq leaderboard was lit up.
But here's where it gets really interesting and slightly concerning. If we look at the breadth analysis, we see a thin ice rally.
Exactly. This is the divergence that keeps me up at night. Despite the S&P gaining 0.5%, the advanced decline line remained flat, meaning that for every stock that went up, one went down. The average stock isn't participating.
So the generals are marching, but the soldiers are staying in the barracks.
That's the mechanic. Big tech Microsoft, Apple, Meta is sucking all the liquidity out of the room. They are draining the life from mid-caps and cyclicals to fuel their own move.
And technically, this is creating a dangerous signal.
Yes. The S&P 500 cleared that 6,900 resistance level. Price is higher. But the RSI, the Relative Strength Index, is making a lower high.
So price goes up, momentum goes down.
Bearish divergence. It signals exhaustion. It often precedes a bull trap. It suggests that this breakout might not have the legs to stand on its own if the earnings don't justify it.
It's like a car speeding up while the gas tank is running dry.
Perfect analogy. And usually, if traders are nervous about a trap, they buy protection. Let's look at volatility. The VIX, is it spiking?
It's not spiking, but it's not crushing either. And that is the anomaly. It's what we call a coiled spring.
Right. The VIX is just consolidating near 14.5. Usually, on a record close for the S&P, you'd see a vol crush volatility dropping as fear dissipates. We aren't seeing that.
So traders are paying premiums for protection even as they buy stocks.
Exactly. They are along the market, but they are terrified of tomorrow. The cheap hedge window is closed. The market is pricing in a 1.2% move for the S&P 500 over the next 48 hours.
1.2% implied move. That is huge for an index.
It's massive. They know something is coming.
Well, they know exactly what's coming. Let's pivot to the macro hook, because tomorrow isn't just a Wednesday. You've called it the Super Bowl of the week.
It is the undisputed main event. We have a double catalyst that rarely happens on the same day. You have the Fed delivering its first rate decision of 2026.
Which is a big deal on its own. The market is desperate for a cut, or at least a signal.
Huge. But it's colliding with the earnings trifecta. Microsoft, Meta, and Tesla all reporting.
That is trillions of dollars of market cap on the line in a 6-hour window.
It is. And here's the risk. The market, as we just discussed with those record highs, is efficiently priced for perfection.
So good news is already baked in.
Correct. When you are at an all-time high, good isn't good enough. You need great. If big tech misses, even slightly, there is no safety left in the value stocks. The Dow is already bleeding, remember? There is no rotation trade left to catch the fall.
That explains the fragile equilibrium comment. S&P at record highs, Dow bleeding out. It feels like we are walking a tightrope.
And the wind is picking up. If the Fed comes out hawkish or if Microsoft guides lower, that thin ice we talked about cracks immediately.
All right, knowing that we're walking a tightrope, let's talk about how to trade it. We need to look ahead. You've pulled a couple of high conviction setups for tomorrow morning. Where are we looking?
Let's start with the long side. If the market is going to survive tomorrow, it's going to be because of the leader, NVIDIA.
NVDA, always in the mix. It feels like the entire market is just an NVIDIA derivative at this point.
It certainly feels that way. It closed at dead highs today. The pattern here is a high-tight flag.
Break that down for the listener who isn't a chartist.
It represents massive accumulation. The stock had a big run up, and instead of selling off, it's just going sideways in a very tight range at the highs. It means buyers are absorbing every single share that comes to market. It's building pressure.
So what's the trigger? When does the pressure valve pop?
You watch the first 15 minutes. If NVIDIA clears Tuesday's high, which is $162.50, you look for a squeeze. The target is $168.
Okay, so over 162.50, we ride the momentum. What about the short side, if the tech earnings disappoint?
For that, we look at Palantir, PLTR.
The retail favorite.
It is, but today it showed weakness. It printed a distribution candle, it had an early pump, tried to break out, and then it just failed.
Classic pop and drop.
Exactly. It trapped the bulls who chased the morning open. The trigger here is a break of today's low, which is $74.20.
And if it loses that?
If it loses that, all those people who bought today are underwater. They will panic sell. The target is a gap fill down to $71.
Okay, NVDA for the breakout, PLTR for the breakdown.
Yeah.
But for the S&P 500 itself, you have a specific level you're watching, the gamma. Now, let's keep this simple, but why does this level matter?
This is the gamma wall. We are watching 5,950 SPX equivalent.
That seems, well, it's a very specific level. What is the mechanic there?
It's all about how the dealers, the market makers, have to hedge their books. Below 5,950, dealer gamma flips negative.
Negative gamma. That sounds bad.
It creates a slippery slope. When gamma is negative, dealers have to sell into weakness. So if the market drops, they sell more futures to hedge, which makes the market drop further. It accelerates the crash.
And above it?
Above 6,000 is what we call a gamma vacuum. Price just drifts higher because there is no resistance. Dealers are actually helping support the market, but right now we are pinned right between them.
So what's the strategy? Are we betting on a trend day tomorrow?
The probability of trend continuation tomorrow is only 35%. We are in a mean reversion environment. So the strategy is neutral to hedged. Do not force the trade.
Do not force the trade. That is usually good advice, but especially before a Fed day.
Absolutely. The final directive here is simple. Wait for the Fed's tone. Let big tech provide the bridge to 7,000 or the trapdoor to 6,500. Don't try and guess it beforehand.
You hear that? Don't be a hero in the first hour. Let the market show its hand.
Exactly. The volatility is priced in. You don't get paid for guessing. You get paid for reacting to the confirmation.
Smart. The bell is just the beginning. We'll be watching those levels 162.50 on NVIDIA and that 110 level on silver. Stay sharp out there.
And watch your risk.
Catch you at the next bell.